David is 62 years old. He spent 35 years teaching secondary school in Manchester, raised 2 kids, paid his taxes, or so he thought. Last month, a letter arrived from HMRC, the demand, £14,200. He hadn't done anything dramatic. He sold an inherited rental flat back in 2017, and then in 2023 he cleared out his late father's coin collection. Things that had been sitting in boxes since the 90s. He didn't hide anything. He just didn't know he needed to declare it. I've spoken to 3 people in the last month who got these letters while clearing out lofts for downsizing, exactly the stage you're at. Good. Ordinary people who didn't know the rules for selling old personal possessions or inherited property. Here's what nobody tells you up front. That £14,200 demand is probably 4 times what David actually owes. HMRC's system sends automated letters based on raw data from platforms and marketplaces. It assumes 0 costs, 0 allowances, and no context. It's a starting position, not a final bill. There is a 30-day window to respond. And if you use the first 14 days wisely, you can reduce that bill dramatically, sometimes by 75% or more. But you need to know what you're dealing with before you pick up the phone. And here's the part that shocked David most. HMRC can legally look back further than most people think, much further than the 4-year window that gets mentioned in generic tax advice. That's where this gets serious. HMRC doesn't randomly select people for these letters. There's a system behind it, and if you've sold anything online in the last few years, old furniture, collectibles, clothes, anything, your data may already be sitting in their records. Since the 1st of January 2024, digital marketplaces are legally required to share seller data with HMRC. That includes eBay, Etsy, Vinted, and Airbnb. Short-term rental platforms were included in this list from the start. And from 2027, crypto exchanges will share transaction data under new international reporting rules. HMRC expects to receive data on up to 2.7 million UK online sellers under these rules. When HMRC gets that data, they match it against your tax returns. If there's a gap, income on their side, nothing on yours, a letter goes out. It's automated, and the number in that letter assumes no costs, no allowances, and no exemptions. In David's case, HMRC received his coin collection sale data from an online auction platform. They classed it as trading income, as if he was running a business, rather than a capital gains disposal on personal possessions. That's a completely different tax treatment, and it pushed his bill far higher than it should have been. I used to think ignoring any HMRC letter was illegal. Turns out you have 30 days to respond, so taking 14 days to prepare is well within the limit. The letter isn't a court summons, it's an opening position. What you do in those 14 days matters enormously. But first, you need to know exactly how far back HMRC can actually look, because this is where I was wrong for years, and where most generic advice gets it completely wrong too. Most advice online tells you to keep tax records for 4 years. That is not wrong, exactly, but it misses the full picture in a way that can be genuinely expensive. HMRC's discovery assessment rules set 3 different look-back periods depending on how an error is classified. 4 years for an innocent mistake where you genuinely didn't know something was taxable. 6 years for a careless error, something you should have checked but didn't. And 20 years for deliberate evasion, where HMRC believes you knowingly hid income. David's case falls into the middle category. He didn't declare rental income from an inherited flat he owned from 2020 to 2022. He didn't know he needed to, but HMRC classes not knowing as a careless error, not an innocent one. So the 6-year window applies. In May 2026, that means they can go all the way back to May 2020 for careless errors. And David's 2020 income sits right within that reach. I once forgot to declare a £500 crypto gain in 2021 and spent 3 nights waking up at 3 a.m. convinced something terrible was going to happen. Then found out it was below the annual exempt amount, and I didn't even need to declare it. The fear was completely disproportionate to the actual situation. That's what these letters do to people. The 6-year rule catches a lot of people at this stage of life. You may have had rental income from a property you've since sold, An old side hustle during the financial crisis years. A lodger who paid cash. None of it feels like evasion, and most of it isn't. But the clock is longer than most people realize. Now, David's coin collection is a separate issue entirely, and the tax treatment there is very different from what HMRC's letter claimed. When David sold his father's coin collection in late 2024 for £12,000, HMRC treated it as trading income, as if he was running a business, rather than a capital gains disposal on personal possessions. That's a completely different tax treatment, and it pushed his bill far higher than it should have been. That classification was wrong. Selling personal possessions, coins, antiques, jewelry, old paintings, vintage items, falls under capital gains tax, not income tax. And there are two specific exemptions that the generic letter completely ignores. First, if you sell a personal possession for £6,000 or less, there is no CGT at all, regardless of what gain you made. That exemption alone removes a large chunk of typical loft clearances from the tax picture entirely. Second, there's a £3,000 CGT annual exempt amount for the 2026 to 2027 tax year. Any gain below that threshold is also tax-free. David's collection originally cost around £2,000 in 1990, sold for £12,000 in late 2024. That's a gain of £10,000. Subtract the £3,000 annual exempt amount, and the taxable gain is £7,000. David is a basic rate taxpayer. His total income from state pension and private pension puts him in that bracket, so the CGT rate is 18%. His actual tax bill on the coin collection, £1,260. HMRC's letter demanded £2,400 plus penalties. The correctly calculated figure is £1,260. That's a difference of over £1,100 just from applying the right tax category. I don't know every item in your loft, but the rules apply in the same way regardless of what you're selling. The question is always the same: personal possession or trading stock. That distinction changes everything. But what if you have no receipts from 1990? Most people don't. And here's the part that surprises people most. This is the question I hear most often. I've got no paperwork from 30 years ago. How do I even prove what I paid for it? HMRC does not expect you to produce a receipt from 1990. What they require is a reasonable estimate of the original cost, and they accept several methods. For items with historical price records, you can use published guides or catalogues from the era. David used a 1990 coin price guide to estimate his collection's value at £2,000. No original receipts, no problem. HMRC accepted it as a valid cost base. For UK capital gains tax, individuals cannot adjust the acquisition cost of an asset for inflation. David must use the actual nominal cost of £2,000 to calculate his gain, as indexation allowance is not available to individuals. For higher value items, jewellery, artwork, antiques, a professional valuation from an auction house or specialist is usually sufficient, and it doesn't need to be expensive. If items came from a late spouse's estate or from a probate situation, a simple written list of items and your best estimated values is generally accepted. The burden of proof is on HMRC to show your estimate is unreasonable, not on you to produce original documentation from 3 decades ago. I've had one of these letters myself 5 years ago, so I know that knot in your stomach when you see the HMRC logo on an envelope. What helped most wasn't a solicitor or a specialist. It was sitting down with the bank statements and working through what actually happened versus what HMRC assumed had happened. The numbers looked very different once I'd done that properly. David thought his biggest problem was the coin collection sale. Then he reread the letter and saw a line about going back to 2010. He thought 6 years kept him safe. He hadn't read far enough. The 6-year careless error window protects you from a lot, but not from everything. If HMRC determines that an omission was deliberate, that you knowingly didn't declare income, the look-back period extends to 20 years. That means undeclared income from 2006 is still collectible in 2026. A lot happened between 2006 and 2016. The financial crisis. Redundancies. people turning spare rooms into rental income, side work that felt informal at the time, cryptocurrency in its very early years. According to the Money and Pensions Service, 18% of UK adults over 55 have some form of undeclared income, from online selling, old rental arrangements, or crypto. That's roughly 1 in 5 people watching this who may have something that could fall within HMRC's reach. The difference between careless and deliberate matters enormously. If you genuinely didn't know rental income needed to be declared, that's likely a 6-year window. If you knew and chose not to declare it, HMRC can treat it as deliberate evasion and go back 20 years. The important thing to know is this: voluntary disclosure changes the calculation. If you come forward before HMRC sends a letter, penalties can be reduced to 0% for careless errors or significantly reduced for deliberate ones. If you wait for HMRC to find it themselves, you lose that reduction, and the interest compounds on top. David can't afford a £14,000 bill. His income is his state pension and a modest private pension. For a moment he thought about doing nothing, just ignoring the letter entirely. That would have been the worst possible move. The first thing to understand is that you do not have to respond immediately. You have 30 days, and the 14 days before you respond are the most valuable time you have. Here is what that preparation period looks like in practice. Day 1. Read the letter carefully and note the exact figures HMRC is claiming, the tax years covered and the deadline. Do not call them yet. Days 2 through 7. Gather your bank statements for every year mentioned in the letter. Separate different types of income: rental income, online sales, asset disposals, because each one has different rules and different tax treatment. Days 8 through 10. Work out your allowable expenses. For a rental property, that includes letting agent fees, repairs, insurance, ground rent, and service charges. David claimed £3,000 in expenses from his rental income that HMRC had ignored entirely. Days 11 through 13, check which CGT exemptions apply. Items sold for under £6,000, exempt. Gains under £3,000, exempt. Estimate original costs using published guides or professional valuations if needed. Day 14, if the corrected figure is substantially different from what HMRC claimed, call them with your recalculation. If you can't reach a resolution, a formal written appeal buys you more time. A viewer last week told me she got a £22,000 demand, called HMRC immediately, admitted to 5 years of eBay sales, then later discovered she had £8,000 in allowable expenses she hadn't mentioned. She's now appealing, but it would have been considerably easier to prepare that case before the first call. David followed this preparation process. HMRC's original demand was £14,200. After claiming rental expenses, correctly reclassifying the coin collection as CGT, and applying the annual exempt amount, the bill came down to £4,500. He arranged a time-to-pay plan, 12 months, plus interest, through the HMRC app. That's manageable on a pension. I did exactly this 5 years ago. Put the letter in a drawer for 2 weeks while I gathered everything. Ended up owing £600 instead of the £4,000 they initially demanded. Preparation is everything, but not everyone can afford an accountant. A tax specialist for a disclosure like David's would typically charge £500 or more. For someone on a fixed pension, that's a significant outlay on top of an already stressful bill. Paying an accountant £500 or more to handle an HMRC disclosure is not something most people on a fixed pension can absorb easily. The good news is that you do not have to. TaxAid is a registered charity that offers free tax advice to people on lower incomes. If your income is under around £20,000 a year, you can request free help from a trained tax advisor who understands exactly this kind of situation. David used TaxAid to review his figures before responding to HMRC. It saved him £500 in accountant fees and gave him the confidence that his recalculation was solid before he made the call. TaxHelp for older people is another option, specifically focused on people over 60 with modest incomes. HMRC's own self-assessment helpline is also underused. They will walk through the technical rules with you at no cost. They won't prepare your response for you, but they will confirm the correct tax treatment for specific situations, including the chattels rules and the lookback periods. For anything more complex, the Citizens Advice Bureau has trained advisors who deal with tax disputes regularly, and the service is free. Some local law centers also offer free representation for tax appeals. The barrier for most people in David's situation isn't actually money or rules. It's something harder to deal with. 72% of people who avoid opening mail say they feel anxious, ashamed, or fearful, according to the Money and Pension Service. That shame is real, and it's one of the main reasons people avoid dealing with these letters until the deadline is passed. I used to think that anyone who hadn't declared income was evading tax. Then I worked through David's case, and I understood something different. He didn't know that selling his father's coin collection had a tax implication. He didn't know that rental income from an inherited flat needed to be declared. He wasn't hiding anything, he just didn't know the rules. And those rules are genuinely complicated. The CGT exemption for chattels, the 3 different look-back windows, the difference between trading income and capital gains on a personal possession. These are not obvious. They're not part of any school curriculum. They weren't explained when you inherited the property or when you listed the coins online. The shame that comes with an HMRC letter is almost always disproportionate to what actually happened. Avoidance is what creates the real problem, because missed deadlines trigger automatic penalties, and those penalties compound quickly. A 30-day deadline that passes without response can turn a manageable bill into a much larger one. You don't need to feel like a criminal to take this seriously. You just need to sit down, work through the numbers, and respond within the window. That's it. If an HMRC letter has landed on your doormat, or you think one might be coming, here's the short version of what to do. Give yourself 14 days before you respond. Read the letter carefully, gather your records, separate each type of income, claim every allowable expense, and check which CGT exemptions apply to anything you've sold. Estimate original costs using published guides or professional valuations if you've no receipts. HMRC accepts reasonable estimates. Check which lookback window applies to your situation. For innocent mistakes, it's 4 years. For careless errors, it's 6 years. Deliberate evasion is 20 years. But for most people watching this, the 6-year window is the relevant one. If the bill is still unaffordable after your recalculation, HMRC's time-to-pay arrangement lets you spread payments over 12 months. Use the HMRC app to set it up without speaking to anyone. If you need help, TaxAid and TaxHelp for older people offer free support for people on modest incomes. Citizens Advice is also free and can help with formal appeals. David's £14,200 demand became a £4,500 bill. That's what preparation does. You've worked your whole life to build the financial position you're in now. An HMRC letter doesn't have to undo that. It's a process, and it's one you can work through. If this helped, please subscribe to Arthur's UK Retirement Guide. Hit the bell icon so you don't miss future videos on retirement tax rules, pension planning, and protecting what you've built.